Hey everybody, Rob Maurer here. Happy Friday. Today we are going to be talking a little bit about Tesla stock, of course, as we've had quite the rally the last few days heading into Memorial Day weekend. A really nice day to wrap up the week. So we're going to take a look at where things might go from here. I've done some plotting of historicals from year to date to Memorial Day and Memorial Day to end of year. We're going to take a look at that. Pretty interesting data. We've also got news from Credit Suisse. They have issued a note on Tesla after their visit with investor relations at Fremont. Got a couple other stories on Tesla and some general EV news as well. And then we'll head into the long weekend. No episode on Monday as the markets will be closed for Memorial Day. All right, so let's get into it today. Obviously a nice day. Tesla up 7.33%, closing at $759.63. I think we're up 20% or so in the last couple of days. The NASDAQ up 3.3%, so one of the best days so far this year. And I think during this rally, the NASDAQ has been green most of these days. So obviously Tesla riding a little bit of that wave, but significantly outperforming as a higher beta stock. But really nice to have a little bit of that recovery so far. The other thing to kind of point out here is we talked earlier this week about Elon Musk reducing or eliminating that margin loan that he'd had for the Twitter financing. We have yet not seen any Form 4s yet from that. So that's really exciting. It means that Monday, Tuesday, and end of day today, Wednesday, would mean no sales from Elon Musk as long as there's no more Form 4s or not any Form 4s by the end of the day today. But for sure, no sales on Monday. For sure, no sales on Tuesday. We got that updated filing on Twitter on Tuesday. So by the time Elon had done that, by the time that margin loan was eliminated, Elon had not sold any further. So that's a good thing. And I think also probably helping take a little bit of the pressure off the stock. Obviously, something could change. Elon could still sell. But as of the elimination of that margin loan, that was not the case. All right, so I want to hop over into Excel here really quick. And I do apologize for the audio listeners since this is more of a chart situation, but we will go through this pretty quickly. So first thing I want to look at here is just some data I was kind of looking at today because, I mean, I always talk about how Q3s are great, right? But generally the second half of the year for Tesla is quite a bit stronger than the first half of the year. And as we're going through Memorial Day weekend, I thought it'd be interesting to take a look at that historical performance. So I kind of mapped that out here. If we look at every year in Tesla's history, so not excluding any dates from 2010 through this year, the average performance for Tesla stock from January 1st to Memorial Day weekend has been up 25%. So in that first, third, almost half of the year, Tesla's risen 25%. Now, from Memorial Day to December 31st, Tesla has risen in that period on average 51%. So almost twice as strong of a performance in that latter half of the year as in that first half. And some of that is driven by a couple of outliers. So 2013 and 2020, Tesla, of course, had greater than 4x, 5x appreciation in the stock in those years. So definitely not a normal year, as sad as that is to say. Can't get that every year. But if we exclude those two phenomenal years, we still have this large discrepancy where the other years on average increased 2% in that first January 1st to Memorial Day period. And then from Memorial Day to the end of the year increased 23%. So again, really strong performance in that second half of the year. The medians, if we look at those, similar. There's a less wide of a discrepancy, but in both cases, that second period is outperforming. And then we can look at the total year's performance there as well. So I did put this in graphical format as well. It's kind of interesting to look at. Hopefully that made sense. So here is, that's not the one I wanted to show first, but here is basically each year plotted out in terms of its performance throughout the year. So you start January 1st, you go through December 31st, and measure the percent change from that first day of the year, or the last day of the previous year rather. And obviously there's a lot of volatility as time goes by, but we can see here this is actually one of the worst starts for Tesla. If we zoom in on this red line, that's this year to date. And we can see that it's the second worst performing year so far at this point in the year. But it's not uncommon for Tesla to be negative at this point of the year about half the time, it looks like, maybe a little bit less than half the time. Tesla through Memorial Day has been negative year to date. But then by the end of the year, for the most part, Tesla ends up finishing positive. So I think there's just one occasion here where Tesla actually didn't end the year with a higher share price than it began the year. But as you can see, 4 or 5 times where at this point in the year we've been negative. So as I mentioned, 2013 and 2020, these are the 2 outlier years in here. So that kind of makes the table a little bit more difficult to look at, or the chart rather. So if we kind of exclude that, we can see here a little bit more of a fair representation of what an average year kind of looks like. And again, you see the volatility there, but it really shows that this year has been one of the worst starts we've ever seen. Really the only year that's been comparable was 2019. And even though Tesla ended up down, 43% or so at this point in time in 2019, it did end up recovering and finished the year up about 25%. So it's not to say that there's hope, but just to say that, we've been in circumstances like this and Tesla has done just fine recovering throughout the rest of the year, even though things can seem a little bit doom and gloom. There's plenty of time left, and certainly wouldn't be unprecedented to see Tesla continue to perform really strong from here. I think I mentioned earlier Q3 is really strong, and I talk about that a lot, but you can really see that come to life in this graph too. A lot of the growth seems to be concentrated here in the fourth quarter. Obviously, particularly in 2019, that happened after the Q3 earnings report. That was definitely a memorable one. I remember that because Tesla changed over their format to what they do now for earnings reports. They used to kind of just do like a Word document. Now it's more of an actual nice PDF. But that was a great earnings report, and really drove the success through the end of the year that year. So anyway, plenty of year left, and I just thought this was kind of an interesting look at the data. All right, so next up here, we've got an updated note from Credit Suisse. Let me hop back into the browser. So they just met with Tesla's investor relations team, and they've issued an updated note. They are keeping their same price target. So we've tended to see analysts reduce their price target. I know I'm covering it a little bit there, but they have kept their $1,125 price target and their outperform rating on the stock after this visit. Not too much in here that was really all that new, to be honest. They talked about lithium iron phosphate, how Tesla eventually is probably going to go to greater than 50% of sales as lithium iron phosphate. They pretty much said that in the previous earnings report. They updated their delivery expectations. We'll talk a little bit about that in a second. And their earnings per share estimate is now $12.58 for this year, and I believe that's non-GAAP. So still pretty low for the year, but despite that, keeping a pretty low price target. And then for next year too, you can see $17, which I also think is quite low, especially on a non-GAAP basis. But basically they're just like walking through what's happening at Fremont. They believe that Fremont is running at really high production rates. So I think most of us expect a greater output from Fremont this quarter than last quarter, and some of the takeaways that they have here seem to support that idea. Talks a little bit about Austin and Berlin, just basically that the cost structure there should be lower than Fremont, which again, we've heard Tesla talk about. And then, chip shortages remain the key gating factor. So no surprise there. It also talked about Shanghai being contingent, the ramp at Shanghai being contingent on supplier ramps in China as well. So getting to their delivery forecast, then they have adjusted it downward just because of those Shanghai lockdowns. They are now at 240 to 250,000 vehicle deliveries for the year, which was down from their estimate before of 295,000. But again, they view this as more of a short-term issue, so no change to the price target. So kind of on that note, I do have news on China, and we are going to hop back to Excel here. Let me flip back. Because what I have heard is that Giga Shanghai, as we had talked about, started that second shift. And apparently they've already hit 2,500 vehicles per day of production, even though they just added the second shift. So that's great news if that turns out to be accurate. So I've kind of split up my production table here a little bit. Let me zoom in specifically on what we're looking at. But earlier this week, we had talked about how the Ministry of Industry and Information Technology out of China had said that Tesla had produced about 26,000 vehicles through May 19th. So we kind of knew these numbers here for the first half of the quarter, basically. If we assume that Tesla was at about 1,000 per day until the second shift started, which would have been on May 25th, that would have been roughly another 5,500 vehicles. And then if they did get to 2,500 per day, and they do that for 6 of the remaining 7 days in May, which is align with the Reuters report that we had previously heard. That'd be another 15,000 vehicles for May. So I had said before about 30,000 was kind of what I was expecting for May, but this would put us more towards like 36,000. So that's kind of like the benchmark that I'll be looking for when we do actually get the CPCA report for May production, which should be, about 2 weeks from now. So then we head into June, and if June can maintain that 2,500, 2,600 vehicles per day, 6 out of 7 days a week, then that would put June at about 67,000. I wouldn't put it past Tesla to be able to overachieve that. Maybe they'll go to some weeks being 7 days a week. But if we just go off of that Reuters memo, this is how June will look if production is smooth, which is obviously contingent on supply chain, as we just talked about with that Credit Suisse note. Anyway, if June does come in around that level, again, I think there's potential error bar in both directions on that. It'd be about 114,000 from Shanghai. If we, have 130,000, a slight increase from Fremont, and then about 15,000 from Berlin and Austin, that'd get you to 260,000 for the quarter. So it's a little bit higher than maybe the 250, 255 scenario that we went through before. Again, this is just a scenario, not necessarily my forecast. I actually think there's probably a little bit more upside here in Fremont. And then hopefully by the end of the quarter, we'll have a little bit better information on Berlin and Texas too. But I definitely think 260 right now is a pretty reasonable number. Hopefully it'll trend up towards 265, 270 as we get closer to the end of the quarter. So that's the news out of Shanghai. So I'm pretty excited about that. We'll hop back to the browser here. And we don't have a ton of other news besides that. Just kind of a few quick stories here. So the first one, just really an update. Great, I don't know where that went, but really just an update here on the vehicle fire that happened in Canada. So we had talked about two, one in Canada, one in California. NHTSA is asking Tesla for more information on that Canadian fire, so just something to kind of keep an eye out on. I think, there was some conversation about the manual releases for the doors in that scenario. The driver didn't think about using those or wasn't aware of them. So I don't know if NHTSA's wondering about that, but it shouldn't be too big of a deal. Just something to keep an eye on. Similarly, I would say in the same category, Twitter shareholders suing Elon Musk, which you could pretty much expect in any deal like this, I think. Maybe not any deal like this, but any deal where there's this back and forth. Not surprising to see this pop up. So just something that we'll have to remain on the radar as this, Twitter saga continues on. But I think we're kind of all over that at this point in the week, so we'll move on from that quickly. The next item here, this one's really interesting. This is this is a study from Cambridge Mobile Telematics. They're looking at electric vehicles and trying to compare sort of the safety of those electric vehicles in real world situations versus internal combustion engine vehicles. And one thing they looked at was EV drivers driving the electric vehicle versus those drivers driving an internal combustion engine vehicle. So it's like, okay, if I drive a Tesla and then I go out and drive a rental car or something, how does safety compare in those circumstances? And one of the things that they found in this analysis, I'll just try to read the quote here. Among the most compelling new findings are the comparisons between drivers who operate both an electric vehicle and an internal combustion engine vehicle, allowing for a better understanding of risks across vehicle platforms. These findings include an analysis of Tesla drivers who also operate another vehicle. These drivers are nearly 50% less likely to crash while driving their Tesla than any other vehicle they operate. We conducted the same analysis on individuals who operate a Porsche and another vehicle. In this case, we observed the opposite effect. Porsche drivers are 55% more likely to crash while driving their Porsche compared to their other vehicle. So that's not necessarily on the Porsche side, electric vehicles. It's not just the Taycan versus any other car, but for Tesla, obviously all Teslas would be EVs. So it's interesting to see that data. One of the things that they had found that's a little bit less positive is that electric vehicles exhibit acceleration risks ranging from 180 to 340% higher than when driving traditional combustion engine vehicles. So while that isn't necessarily positive news for electric vehicles, more acceleration means potentially more accidents in those cases. Tesla's seeing the opposite of that even though Tesla, obviously, one of the fastest accelerating electric vehicles. So it's interesting. I think it speaks to probably the active safety features in Tesla's vehicles. There could be driver factors there too, but if you had to kind of pinpoint one thing, that would seem to be the one thing that would stick out in terms of, where Tesla is a little bit differentiated in a way that could drive this. Otherwise, Tesla drivers are just like paying more attention when driving a Tesla, or driving a Tesla has made them more prone to accidents in other vehicles. We don't have enough data there to really make a conclusive point, but it is interesting to see such a huge discrepancy, especially when they pull in that Porsche statistic. So I don't know if they've published more information on this. They were having a keynote on it. I haven't had a chance to look into that, but just kind of some interesting data there. Some more interesting data here. So we got a report today from JD Power. They do various studies, and they've released their findings from their electric vehicle consideration study. And they've found that vehicle shoppers that they surveyed this year, 24% of them said that they are very likely to consider an electric vehicle for their next purchase. I don't think that's really actually the best in terms of what I might expect. That's only 4 percentage points higher than a year ago. And I think if we sort of mentally turn our clocks back a year with, the Super Bowl commercials and just all the attention around Tesla, Elon Musk, other electric vehicles this year in terms of just ads outside the Super Bowl, I'm a little bit surprised that it's not grown faster than that. 20 to 24% in a year is really not that big of an increase. It's decent, but I would have expected more if I was asked to guess what the results would have been. They did find some differences in terms of sort of like the tiers of vehicles. Looked like let's see, find my spot here. So 37% of premium vehicle owners indicate they're very likely to consider an EV versus just 21% who own mass market vehicles. So that's actually pretty consistent. And I think there was another part in here where they said, let's see. Let me just try to quickly search for this. That's not what I meant to type. I think the mass market vehicle consideration was up by a greater percent than last year. So owners of numerous mass market brands expressed an increased interest from EVs a year ago. At the same time, owners of several premium brands, including Tesla, expressed somewhat less interest in making their next vehicle an EV. So I think, I can't find the statistic offhand, but I think they said that consideration for premium vehicles only increased 1 percentage point, and in mass market increased much more significantly. So it's kind of interesting to see maybe the rate of interest declining a little bit, and particularly in that premium segment. So not anything that I would have a major takeaway from at this point, but just kind of interesting, something to keep an eye on for, when JD Power releases this study in the future. All right, and then kind of the last thing here. So just a quick update on Rivian. They have sort of reorganized their leadership team, and that has resulted in the ouster or the leaving of their head of manufacturing. I guess it's not clear if that's Rivian led or if that's the person deciding to leave the company. But either way, some adjustments there at Rivian with their head of manufacturing leaving. And this is actually similar to something we didn't have a chance to talk about earlier this week, but Lucid as head of quality, I want to say, I can't remember the exact title for this person, also left the company this week. So interesting time for these, new EV startups as they are trying to ramp production, and we're already seeing quite a bit of turnover through that process for the key leaders of those businesses. So kind of interesting there. All right, I think that is it then. So let me just take a super quick look at the chat here. I think I saw one super chat if I remember correctly. I wish these were easier to find in the streaming software that I use. It's a little bit difficult. So yeah, I do apologize if I missed that. I'll try to look for it and then get back to that person in the comments if I can. All right. Yeah, that's where we're going to leave it for this week then. I guess just to kind of wrap up with, the title. I'm feeling pretty good about where things are at. Certainly from a Tesla perspective, we got Giga Shanghai now ramping back up. Austin and Berlin, we're 3-4 months into the ramp of those really starting. So that's generally around the time that things start to pick up a little bit. Shanghai coming online, Fremont obviously continuing to do well. There's just been a lot of negative things this quarter, and we felt the impact of that. But from here, things look like there's a pretty clear trajectory. Obviously, things can change, and who knows. But I think from a Tesla perspective, things are looking quite good. And then from a macro perspective, I think there's some positive signs. I'm not ready to say that, peak inflation. I think we probably already hit peak inflation in terms of the March report. We kind of already talked about that stuff, but a lot of that peak inflation is just because the numbers from last year are starting to be higher comps. So for me, from an inflation perspective, the month-over-month changes are much more interesting, even though peak inflation will be part of the narrative. But I do think with supply chains hopefully coming back online, Shanghai hopefully opening up a little bit more, hopefully things are getting a little bit better from a macro perspective. That's even more difficult to predict because so many different things can affect that are unknown. So in general, I'm feeling pretty good about things, but still a lot of uncertainty ahead. But as we head into Q3, it's always my favorite quarter, and I'm sure it will be the case again this year. So with that, we'll wrap it up. I hope everyone has an amazing Memorial Day weekend. And again, in case you missed it earlier, we'll be off on Monday with the markets closed. So we'll see you again for the Tuesday, I believe that will be June 1st episode of Tesla Daily. Maybe that's probably May 31st. So we'll see you then. Until then, you can find me on Twitter at Tesla Podcast, and make sure you are liked and subscribed. I'm messing up my closing here. Make sure you subscribe, sign up for notifications. You can like if you want. That's fine. I do appreciate it. But until then, we'll see you on Tuesday. Thank you.